Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
It is time to check in with Bloomberg Opinion. We're joined by opinion columnist Shuli Ren, who is writing about Vanke, the Chinese developer that recently had its credit rating cut to junk. Shuli, thanks very much for joining us. So there's a debt swap plan that is being considered, but it doesn't change the fact, does it, that there's just no clarity on future sales here for these developers?
That's absolutely right, Brian, and that's why the Chinese government is perhaps nudging its state-owned banks to consider a debt swap. The thing with Vanke is until basically this Monday, it was an investment-graded real estate developer, and it's not anything like a China Evergrande or Country Garden. It has a professional management, and its balance sheet is fairly sound. However, because China's physical market is doing so badly that even Vanke's sales is being dragged down, and it just looks like it may not be able to make the next bond repayment schedule.
Yeah, so you're facing a liquidity crunch. Do you think there'll be some type of reorganization to try to remove some of that stress?
Well, investors probably hope not, because restructuring usually means very, very little returns to their investments. But at this point, you will have to, because with Vanke, right, last year, China's property market was doing very badly, but it was doing not too bad. Its contracted sales was down only 10% because it was taking some market share away from the likes of Country Garden and Evergrande. But this year, in the first 2 months this year, we are seeing a 40% drop from 1 year ago. That just shows that at this point, it's not just about this or that developer, but about the overall market. Chinese households are just not willing to go into the primary property sales, and some of them are going into the secondary sales, in which case the developers are not getting any benefits, right?
You say that a government bailout of Vanke would actually be good for the government. Explain.
Well, because just like Hong Kong, the Chinese government, local governments, they rely heavily on land sales. Land sales can account for up to 1/3 of their total revenue. So what we're seeing is that Chinese local government's revenue from land sales is already down 1/3 from its 2021 high, right? So if Vanke still goes down and no developers are left in China, then how are they going to sell their land? It is a big fiscal problem. I think if at this rate, even the likes of Vanke cannot survive, that means there will be no private sector developers left, and no local governments can sell any land.
So if you're talking about a bailout, everyone is whole, right? We're not talking about a cash infusion, maybe in a little bit of state-sponsored reorganization to kind of get things more in line. But you're talking about a full-blown rescue of the company.
Well, one possibility is what Chinese government did to the distressed local governments, basically allowing Vanke to issue debt at a substantially to refinance its public debt at a substantially lower rates. That's one possibility.
So that would be a sort of restructuring then, right?
Well, It is. It's a restructuring of debt, but it's not a restructuring of the company's business operations.
Now, you say that Vanke, has a strong past and a quality management, and that it's closely intertwined with Shenzhen. Well, why does that make a difference?
Well, it's kind of Vanke is symbolic. It went public in Shenzhen in 1991, and Shenzhen was basically the first city that adopted private home ownership in China, right? Before that, all the Chinese, they live in those crappy housing provided by the state-owned employers, etc. So Shenzhen was a pilot city for this new home ownership model, and Vanke was a pioneer in that pilot city. So if Vanke goes down, it's quite symbolic in the sense that, Deng Xiaoping's southern tour is getting reversed.
So it's almost like we're looking at the end of privatization of property developers in China. It's going to be state-sponsored.
Yes, absolutely.
What's tricky, though, is that when you look at Evergrande, with the liquidator here in Hong Kong trying to sell assets in China, it's a mess. I mean, certainly the government doesn't want that again, right?
Evergrande is a completely different story. But the problem with liquidators in Hong Kong is they like Evergrande, the company that the shell company that issued those dollar bonds. It is a shell company, and it doesn't have a lot of operating assets overseas. So the liquidators in Hong Kong, their best case scenario is basically to call back whatever Evergrande has outside of mainland China. Okay. Once you go into mainland China, they're way down the pecking order in terms of creditors.
Absolutely. All right, Shuli, thank you. Bloomberg Opinion columnist Shuli Ren. You can find her pieces on the terminal by typing OPIN GO.
Mark Cranfield. He is our M-LIV Strategist. If you have a Bloomberg terminal, the function is M-LIV, then the green Go key. Mark, doesn't seem to be moving the needle here on expectations that we're going to see a Fed rate cut sometime mid-year, right?
Well, people are waiting for the dot plots at the next week's FOMC. That's really the big issue. And you've heard a variety of Fed voices over the past couple of weeks. Obviously, they're in a blackout now, so there won't be any comments this week. But you can see there's a divergence between different people in the Fed. We've even had Neil Kashkari saying that maybe only one rate cut is necessary this year. There's a number of people that think only 2 cuts is necessary. And then at the moment, the dot plots officially, they still show a median of 3 cuts. So another CPI number, which has come in slightly above forecast, obviously puts into question the whole outlook for the dot plots. And that's what traders are waiting to see, whether or not they drop the number to 2 cuts for this year, would they leave it at 3, or do we even have maybe dropping even to 1? But certainly a change to only 2 rate cuts this year is a distinct possibility, and that's keeping everyone a little bit on edge.
It seemed like this report, the CPI report, was a little bit like the jobs report in that there was something in there for both the bulls and the bears. In the end, the equity market chose to kind of set it aside and to rally on it. Is that because there wasn't anything all that surprising in the data, or is it more just that equities are moving more on earnings than on the Fed and macro?
I think what you have to take into account particularly for the US equity market, you have to see, okay, what is really driving the US equity market and how much will a 25 basis point rate cut change to the picture? Well, whether the Federal Reserve cuts by 25 basis points now, in 3 months, in 6 months, it is not going to make any difference whatsoever to the drivers of the US equity market. They've got used to having short-term interest rates about 5% for a long time. They can live with it because the underlying US economy is doing so well. As you say, earnings in many places are extremely good. And one of the other main drivers of the US market right now is the AI narrative, and that has got nothing to do with interest rates. It doesn't matter whether interest rates are 5, 6, 7, they can live with it. The AI story is a completely different sector altogether. And as long as people think that that is a strong medium-term driver of equities, it doesn't really matter what interest rates do.
You're absolutely right about that. I was looking at Oracle today. The stock hit a record high, was up about 12%. Yeah, the cloud computing business is on growing very well. But yesterday, the company said when it announced quarterly results, demand for that Gen 2 AI infrastructure is substantially above where supply is right now. But in the time that we have left with you, I want to get your view on the BOJ because we've got these wage increases increases that will be reported through the week. I guess there's a very heavy docket today. The big number it will be reported on Friday. Do you think we're going to get kind of the preponderance of data that will force the BOJ's hand as soon as next week's meeting?
Yeah, I mean, we've had a big story on Bloomberg saying that the meeting is too close to call. I think you have to take that at face value. And I think it's really just a question of whether the Bank of Japan feels ready to go all in March, or whether to do a step-by-step move. So some in March and some in April. So what we could see yield curve control removed at the March meeting, and probably a message to say no more ETF buying. That would be the end of one part of the policy. And then they leave exiting negative rates till April or till later. They may go all in for March as well. I suspect it will be staggered because they're trying to limit the impact to financial markets in Japan, and they do have the fiscal year end coming up on the 31st of March. So I suspect they won't want to cause too many ripples in March, and they'll leave something on the table for April. But certainly changes are coming, and it's going to be over the next couple of meetings. You'll see the Bank of Japan make some very big steps.
Mark, I tipped this a few moments ago. Perhaps you can squeeze in a quick answer. The Hang Seng Tech Index powering up 20% now from its lows. It had a big jump yesterday. So technically in a bull market. Is that investors believing in the story from China, from the NPC, or something else?
It's probably got more to do with NVIDIA. NVIDIA making record highs after record highs and just accentuating the whole tech and AI story. I mean, who could ignore something like a juggernaut like that has global impact? And I suspect it's got a lot more to do with that than anything going on locally in Asia.
Yeah, we had NVIDIA shares today jumping by more than 7%. So to go back to that AI narrative that you were talking about earlier, it's not yet faded. Perhaps it won't anytime soon. Mark, it's always a pleasure. Thanks for joining us. Mark Cranfield, Bloomberg M-LIV Strategist, joining from Singapore here on Daybreak Asia.
Joining us now in our studios is Daniel Lam, head of equity strategy at Standard Chartered Wealth Management, for a closer look at markets. Daniel, I mentioned that the Hang Seng Tech Index passed 20% higher from the lows, or came up 20% from the lows here of late, so technically puts it in a bull market. It has people, I think, scratching their heads. The one thing I might say is that in China, the NPC did approve a 10% increase in the budget for science and technology, up to $51.6 billion. Is it possible that that is part and parcel of these big gains we've seen in tech in Hong Kong?
Thanks. That's part of it, although I believe that more of it is the fact that some of the investors begin to look for opportunities outside the mega cap US growth stocks. That's what's been happening, connecting all the dots. So you've seen that, of course, within the Magnificent Seven, people are trying to narrow that down to 6, 5, or 4 stocks. So that's become narrower and narrower. And investors have been branching out to look for opportunities outside that set of names. Now, if you're looking at tailwind from, say, lower inflation numbers, well, you're not really getting the full lower inflation, right? Because it's still past the sticky. So the 10-year yield becomes, more solid in terms of level and maybe grinding higher. So investors are naturally looking for other areas to park their money outside the 7 stocks, at least for the short term. So naturally, they're looking at, like China, for example, because it's so cheap, right, in valuation. And you said that, yes, it rebounded 20% from the lows, but, by and large, these stocks are still at a massive discount to the counterparts.
So what are the risks, Daniel?
The risk is that the economy is still not very solid in China, right? So you've seen that the latest CPI figure in China, yes, it's kind of stopped the deflationary trend, one print, but is this going to be sustainable? I mean, the PPI was still relatively tough, right? The latest number. So I guess, the question now is that, if we do see another print of CPI being in the positive space in China, then this rally could continue, but it could be just a blip.
Yeah, I think there's a lot of wisdom in what you said, because I noted that the other day when you had Netflix selling off 10% in a day, you had tech stocks going up in Hong Kong. So among the companies that had a big bounce yesterday was Xiaomi. This is a little puzzling too. I mean, up 11%. The company saying it will sell electric vehicles this month. So it's going into a market which itself has been sort of churning down a little bit. And you're going in and competing against Tesla and BYD, and the stock goes up 11%. Explain that to me.
Well, basically, I would say that the stock's been beaten down a lot, right? Not just the stocks they mentioned, but the whole HS Tech index, right? Every single one of them has been beaten down. So when there's flow of funds coming, you don't need that much flow of fund to make them go up by 10% a day, right? Because it's so beaten down, right? So I would say that in terms of China, the stocks that actually have been working even during the direst of time back in February, right, are the ones where investors could be considering. Okay, so the banks, they have got high dividends, and they were actually pretty solid during that January, February, dire times. Those, of course, would be underperforming in big rebound day like yesterday. But then, I would argue that for the medium to longer term investors, they would be the ones that investors could be looking at, given the fact that the SASAC said that the SOE management should have market cap management as their KPI, i.e. they need to boost the market cap. So SOEs are looking pretty good.
Can we turn to Japan? We've got the BOJ meeting next week. We've got the wage data coming through the end of this week, and maybe that's the determinant, the factor that will let us know whether or not the BOJ intends to change policy for the first time since 2007, at least where the policy rate is concerned. We've been at a negative 10 basis points for feels like a long, long time.
Eternity.
Are you still seeing opportunities in the Japanese equity market?
That's an opportunity, definitely opportunity, because our view is that they will be tightening this year, right? May not be this time, but eventually they will be tightening this year, right? So, of course, that would lead to volatility in the market. Yen is going to strengthen when that time comes, or just before, and the equities will be selling off, right, on the back of that. But the improvement in the corporates have definitely been there. The corporate governance improvement. Earnings have been decent. Foreign interest has been picking up, since the middle of last year. So, all that factors combined means that the pullback is a good opportunity for Japan. But here's a caveat. Caveat is that for the investors, they need to be looking to rotate the sectors. So, higher interest rate, tighter monetary policy, right? That can improve the yield curve there in Japan.
Banks,
and that's
gotta like the banks.
Insurers. Yeah, those. So look at those sectors.
Given the heavy exposure to robotics and to efficiency levels in manufacturing and such, in some ways in the past we've talked about the Japanese companies being a sort of warrant on global growth. And the fact that Japan has been rallying, is there perhaps a little bit of an indication in there that you might see the global economy hold steady or actually turn around and start to gain again?
Well, certainly the no lending probability in the U.S., for example, has been gaining this year. The probability of that has been rising. So, we could well see that the economy may escape that, long pitch recession narrative, right? In which case it's certainly, good for equities. And that's probably the reason why you're seeing that, the U.S. market has been pulling back and then people buying on dips. And I would expect the same to be for Japan, and use this, volatility in the Japanese yen as an opportunity to buy Japanese stocks.
I'm sure it would be a very different world for Japanese equities if the Chinese economy were firing on all cylinders. To what extent, very quickly, Daniel, is a weak China holding back Japan?
Yeah.
Well, in areas, like you said, in automation, we have seen that because of the slowing Chinese demand, it does hurt the robotics or the automation sector, for example. Also, the fact that, slowing China, perhaps less tourists going to Japan, and that slows the Japan domestic economy. But all that can improve if China improves.
All right. Thanks very much, Daniel. We see here year to date, the Nikkei has advanced almost 11%. Daniel Lam has been with us, head of equity strategy at Standard Chartered Wealth Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.